Hey, Andrew here from the Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 19. And today I'm looking at some of the news from this week, which, whilst appearing to be a negative piece of news, might actually have a positive tail. And we're always looking for that little bit of difference of from the headline and the story behind the story in these weekly wisdoms. So that's what we'll do today. Probably won't be an overly long one because it's a reasonably simple thing that we're looking at this week, but we'll see how we go. So this headline, Best and Less becomes latest Australian company to see sales flop. So you might say to me, well, where's the good news behind that? Well, we'll get to that in a minute. But if you've been following any of the news this week, you'll also have seen that one of the oldest chocolate brands in the country is in trouble and is looking for buyers. And Ernest Hillier, if you've ever had one of their chocolates, you'll appreciate the news. They've been around a long time, and they've recently run into some struggles. And you'll also probably have heard about the Fantail no longer being produced. So when you look at that, there's a lot of, I guess, news coming out about businesses starting to struggle. And what that's telling us, the news behind the news, is that spending is drying up. Now, if you've been listening to these weekly wisdoms on a consistent basis, you'll know that we've been talking a lot about interest rates and inflation. And the Reserve Bank, whether it's here in Australia or overseas, in whatever market you're in, the banks have been increasing interest rates with a sledgehammer to try and stop us from spending. And what is one of the outcomes if we stop spending? Then that basically means that company profits slow down. And so this headline here, Best and Less becomes latest Australian company to see sales flop, is an indication that we've stopped spending. And if we've stopped spending, that means inflation should theoretically drop. But the problem that we've been talking about on these weekly wisdoms for some time now is that the inflation that we're dealing with right now is not entirely our fault. It's not our spending that has been driving these numbers through the roofs. Granted, there is an element of that, but there are significant other factors beyond our control, yours or mine, when it comes to why inflation is going gangbusters around the world. And like we've spoken about many times, there's things like the war in Ukraine, and there was oil prices, but they've now plummeted. And then there's energy prices, which are controlled by the government. All these other factors that we've got no control over that are driving inflation. And so with the sledgehammer of interest rates, the outcome that the Reserve Bank wants is for us to slow down our spending. And guess what? We're now starting to see it in a way that most people don't want to see it. And that is when people's favourite brands and companies start to struggle. And the thing that's important about this one is Best and Less, with all due respect, is a brand or is a company that attracts people that are looking for items at a lower end of the spectrum in terms of the spending. It's not a discount, but it's definitely a less expensive brand name, or carries less expensive brand names, and so it's very much targeted at a lower end of the socio-economic agenda. And if they're struggling, that means these interest rates are really hurting the people that can least afford it, and that is not a great sign. But when it comes to what this is telling us, it certainly is telling us that if a company like Best and Less is seeing their sales and profits diminish, then that certainly suggests that we've dried up our spending. And I'm not going to get into all their numbers. I mean, nobody cares about their individual numbers, but basically what it's saying is that it's seen a massive drop in its profits, and it's basically a result, like I said, of us drying up our spending, and for a certain segment of the market definitely drying up their spending. And that part of the market that the interest rates are having the most impact on. So that's the first, well, not the first, it's another sign that those interest rates are starting to hurt. And we should be starting to see some positive news when it comes to inflation numbers in coming months. Now, whether that slows the Reserve Bank's interest rate hiking down, who knows? And like I think I touched on last week, we're seeing over in the US that their inflation is coming down pretty rapidly. So we're up around the 6.8%. The US has come down below 5%. So they're ahead of the curve when it comes to inflation. And so, mindful that, if we follow their trend and we come down pretty quickly, it might be an opportunity for the banks to just slow down a little bit when it comes to interest rate hiking. And like I've alluded to a few times in previous videos, Weekly Wisdoms, and if you haven't watched or listened to them all, go and check them all out on the YouTube channel. But what we have to also understand is that the people coming off fixed interest rates, which is due to, the bulk of those people are coming off in the September quarter, so the back end of the year, is going to have a massive impact on their household spending capacity. So it looks like with these headlines and all these other things that are kind of lining up this year, that the rest of this year is going to see a real slowdown in people's spending, a slowdown in inflation. Let's, fingers crossed, as long as the government does their part. And that should see the pressure on interest rates ease up a little bit. Now, that's no guarantee that the government won't, or not the government, but the Reserve Banks won't continue to hike if they can't get inflation down to their target between the 2 and 3%. But surely at some point, somebody has to wake up and see that these rate hikes are going to bite heavily very, very soon. So, pardon me, keep an eye out if you're seeing news like this. When it comes to your personal wealth and growing your wealth and managing your money, you might see a headline like this and think it's got nothing to do with me. And predominantly, it doesn't. That's why I do these for you, so I can give you the tips of what's going on in terms of the financial markets. And ultimately, you will know probably before it hits the media whether or not you're having any struggles with meeting your expenses, which is a result of obviously cost of living increases and all the rest. But the best way to manage those is to have a plan for your money. So having a defined plan of how you're going to spend your money and how that fits into a bigger plan of putting some money to your future self, pay yourself first for your future self, we can help you with that. Pardon me, sorry about that. So if you want any help, if you want to have a conversation about what's going on in the markets, how we can help you to manage your money and then make it grow, then reach out, leave a comment below, send us an email, whatever it might be. Let's have a conversation and see how we can help you change your money circumstances and grow your wealth more effectively and efficiently. Because I'll let you in on a little secret, which is not that secret, but the secret is that it's times like these when the wealthy are the most active when it comes to growing their wealth. When everyone else is reading all the negativity, they're seeing opportunity. And whether or not we're going to see Boxing Day sales, as I like to describe it, in the financial markets, whether it's the stock market or the property market, we're likely to see some good discounts available over the next 12 to 18 months. And that's an awesome opportunity to lock in long-term, big future gains. So don't be afraid of the markets and what they might do in the near term. Be more concerned about what they're going to do in the long term, and use this time as an opportunity to lock in some really good gains and accelerate your future wealth. So just like I said, a reasonably quick one this week to just show you that there are more and more signs starting to stack up when it comes to what's happening in terms of inflation and what's happening to company profits because of the interest rate rises and because of people's reduced spending. And all of that circles back to hopefully some reprieve on interest rates, a reduction in inflation, and hopefully, fingers crossed, avoiding a recession. But there are definite signs there that our spending has slowed down, and let's hope that we can get the support from others to slow that spending down, slow the price rises down, and avoid a recession. So if you're watching this on YouTube, don't forget to hit the subscribe button. I think it's up there, and the little bell to get notified when we issue a new release, new video. We'd love to have you as a subscriber. And if you're watching this on Facebook, leave us a comment down below. Let us know what you thought. And if there's any topics you want us to cover, let us know about that as well. And we'll see how we can find something relevant to that topic in the media. And otherwise, have a great week. And we'll see you again next week for another weekly Woody Wisdom. Cheers.